Arbor Realty Trust missed consensus on the bottom line this quarter. They reported a GAAP net loss of $37.3 million, which translates to an earnings per share of negative 20 cents.
Yeah, pretty glaring miss.
Right, and they missed on revenue, too. Plus, the forward guidance they gave, well, it was definitely on the weaker side. But despite all those terrible headline numbers, the stock didn't crater in the aftermarket.
No, it didn't. And that's because management simultaneously declared a cash dividend of 17 cents a share. And on top of that, they executed a massive $114 million stock buyback.
Exactly. So we're looking directly at Arbor's second quarter 2026 Form 10-Q and their earnings press release today. And our mission for you is to decode this entirely bizarre set of numbers.
It really is a complete paradox on the surface. I mean, when you look at the raw data, you've got a company that is clearly taking heavy, heavy damage in its core lending portfolio.
Oh, absolutely.
But then they're making these bold, highly capital-intensive moves that project, absolute confidence.
Yeah, imagine watching your house catch on fire. Right. But instead of calling the fire department, you use your emergency savings to buy the house next door just because it's on sale.
That is effectively what's happening beneath the surface here.
Okay, let's unpack this, because at first glance, if you're just skimming the headlines, a $37 million loss looks like a total disaster.
Right. It looks awful.
But to understand how a company loses that much money and, still pays a dividend, we have to look at the stark contrast between their GAAP financial metrics.
The strict accounting rules, basically.
Exactly. The strict accounting rules and their quote-unquote distributable earnings. I mean, it's like checking your bank account after taking a massive one-time accounting write-off. It looks bad on paper.
Right, but the distributable earnings are more like your actual weekly cash paycheck.
Yeah.
And that divergence is the single most important metric for understanding any commercial mortgage lender right now.
Especially Arbor.
Yeah, especially Arbor. The gap between those two numbers is just yawning wide this quarter.
It really is. So the GAAP net loss is $37.3 million, or negative 20 cents a share. But right there in the press release, they heavily, heavily promote their distributable earnings.
Right.
And this is the metric that real estate investors watch like a hawk because it theoretically gauges the company's ability to actually pay its dividend. And that number was a positive $21.7 million.
Which is about 10 cents per share.
Right, 10 cents a share. Yet, despite only earning 10 cents in distributable cash, they declared a dividend of 17 cents.
Yeah.
I mean, I have to stop you right there. You're telling me they only earn 10 cents a share, but they're turning around and paying out 17 cents to shareholders?
That's the math.
That sounds like a Ponzi scheme. I mean, how is it legal or even logical to pay out money you aren't actually making?
Well, what's fascinating here is that it's a completely fair question. And it's exactly what skeptical analysts on Wall Street have been hammering them on.
I bet.
But to understand the legality and, the logic of it, you have to look at the mechanics of what distributable earnings actually means.
Okay, break it down for us.
So GAAP accounting forces a company to take a charge against their earnings for future expected losses.
Yeah.
Even if they haven't actually, lost the cash yet.
Right.
This is called a CECL reserve, or current expected credit losses. When Arbor takes a massive $38 million provision for credit losses this quarter, that hits their GAAP earnings instantly.
So that's what's driving it to that negative 20 cents.
Exactly. They are basically taking a write-off on paper.
Got it.
But distributable earnings strips out those non-cash accounting charges. It adds them back to show the actual cash generated by the business operations during that specific quarter.
So the logic is kind of like, hey, we haven't actually lost this cash yet. It's just a reserve we're setting aside. So let's look at our operational cash flow instead.
Exactly. But here is where your skepticism is entirely justified.
Right.
Because even after adding back all those non-cash charges, their distributable earnings were still only 10 cents.
Which means they're fundamentally short 7 cents per share on the dividend they promised.
Precisely. I mean, paying out 17 cents when you only generate 10 means you are actively dipping into the well.
Wow.
Arbor is using existing liquidity, cash on hand, or, proceeds from other financial maneuvers just to bridge that gap.
So why do it? Why not just cut the dividend?
Because management is making a highly calculated bet. They know that cutting the dividend would signal panic, it would tank the stock price, and potentially trigger margin calls on their own corporate debt.
Oh, that would be a death spiral.
Right. So maintaining it projects stability. But make no mistake, it is a temporary, highly stressful cash drain.
So what does this all mean for the core business? I mean, if you're listening to this and wondering why a company's earnings are so squeezed that they have to drain their savings just to pay their shareholders.
You have to look at the macro environment.
Right. Which brings us to the actual loans Arbor makes. The report shifts our focus to their structured business. And we're mostly talking about their bridge loan portfolio here, right?
Yeah, the bridge loans are the absolute epicenter of the pain in commercial real estate right now.
So let's lay out their raw data from the 10Q. The Federal Reserve held the federal funds rate at 3.50% to 3.75% throughout the entire first half of 2026.
Higher for longer.
Exactly. And the fallout for Arbor is severe. Their provision for credit losses spiked to $38.16 million this quarter.
Which is huge.
It is. To put that in perspective, that is double the $19 million they provisioned in the exact same quarter last year.
A 100% increase in expected losses year over year. That is a staggering jump.
And it gets worse when you look at the actual defaults, not just the reserves. They now have 19 non-performing loans, totaling $428.8 million in unpaid principal balance. And they aren't just sitting on these loans either. They actually had to foreclose on 5 properties totaling $121.4 million in unpaid principal balance.
Yeah, there's a lot of real estate to take back.
The notes actually detail that they took back the keys on 3 properties in Texas alone with a carrying value of about $66 million.
Right.
And the moment they took those properties onto their own books as real estate owned, they recognized $13.6 million in impairment losses right off the bat.
Because the simple, brutal reality is that those apartment buildings in Texas are worth significantly less today than they were when Arbor originally funded the loans.
Well, I'm going to push back on management's narrative here.
Okay.
Because in the commentary, management blames a, quote, softer outlook for commercial real estate and prolonged rate environment. But, I mean, are they just passive victims of the Fed's higher for longer rate policy?
Big question.
Or is this the inevitable hangover of their own actions? Did they just aggressively finance too many shaky multifamily properties at the absolute top of the market, and now the bill is coming due?
You're hitting on the defining debate for the entire sector right now. And to really answer it, we need to dig into the mechanics of how a bridge loan actually works.
Right, because it's not a normal mortgage.
No, a bridge loan is not a 30-year fixed mortgage. It is short-term, typically floating-rate debt. Borrowers use it to literally bridge a gap, usually a 2 to 3 year period where they buy an older apartment complex, renovate it, raise the rents, and stabilize the property.
So it's a value-add play.
Exactly. But the entire business plan relies on an exit strategy. Once the property is stabilized, the borrower plans to refinance that expensive bridge loan into a permanent, lower-rate, fixed mortgage from a bank, or maybe Fannie Mae.
But the Fed broke the bridge.
They blew it up entirely. When the Fed holds interest rates at 3.5% to 3.75% for this long, 2 things happen mechanically.
Okay.
First, the borrower's current floating rate bridge loan becomes incredibly expensive. Their monthly interest payments skyrocket, eating up all the cash flow the property generates.
So they can't even afford to finish the renovations.
Right. And second, the exit strategy vanishes.
Because rates are too high to refinance.
Exactly. When they try to refinance into a permanent loan to escape the bridge debt, the math simply no longer works. We hear the phrase, cap rates expanded, all the time in these earnings reports.
Yeah. What does that actually mean in plain English?
What that actually means is the yield investors' demand for buying real estate has gone up, mainly because risk-free treasury bonds are yielding more. So when cap rates go up, property values mathematically go down.
Ouch.
Yeah. So a borrower goes to a bank to refinance their $50 million Arbor loan, but the bank says, look, your property is only worth $45 million now. We can only lend you $30 million. You need to bring $20 million in cash to the closing table just to pay off Arbor.
And the borrower, who is already bleeding cash on their monthly payments, obviously doesn't have $20 million sitting around.
Exactly. So what do? They throw their hands up and hand the keys back to Arbor.
Wow.
That is the exact mechanism driving those $428.8 million in non-performing loans. The boom years of 2021 and 2022 saw massive origination volumes based on the assumption that rates would stay low.
Or at least return to zero quickly if the economy sneezed.
Right. Those assumptions were fundamentally flawed, and Arbor is now forced to operate apartment buildings in Texas instead of just, collecting interest checks.
And taking back the keys is the absolute last resort. A financial firm doesn't have the infrastructure or honestly the desire to act as a landlord, plunging money into plumbing repairs and leasing offices.
No, they hate it.
But wait, if their structured business is bleeding $38 million in credit losses and they are stuck taking back the keys to underwater apartment buildings, how on earth are they finding the cash to pay that 17-cent dividend?
It's a great question.
And more importantly, how are they finding hundreds of millions of dollars to buy back their own stock? Like, where's the money actually coming from?
Well, this is where we transition from the disaster to the survival mechanism. If you just looked at the bridge loans, you'd think Arbor was marching straight toward bankruptcy.
Yeah, absolutely.
But Arbor isn't just a bridge lender. They have a second, entirely different business model bolted onto the side of the company, their agency business.
Right. I like to think of this contrast using a real estate analogy.
Let's hear it.
The structured bridge loan business is kind of like being a house flipper. It's high risk, it relies on cheap debt, and when the market turns, you get wiped out.
Sure.
But their agency business is like owning the toll booth on the highway. You don't care what kind of car is driving by, you just collect a tiny risk-free fee every single time the barrier goes up.
That is a perfect way to look at it. The agency business is what makes Arbor fundamentally different from a pure-play commercial mortgage REIT that only does risky bridge loans.
So let's look at the numbers for the toll booth because they are incredibly strong. Their agency business originated $1.08 billion in loans just this quarter.
Massive volume.
Right. But the real jewel is their massive $36.7 billion servicing portfolio. According to the report, that portfolio generates about $184 million a year in recurring, mostly prepayment-protected cash flow.
That servicing portfolio is the lifeblood keeping the entire enterprise alive right now. We really need to explain the mechanics of how this works.
Please do.
When Arbor originates a loan through Fannie Mae or Freddie Mac, the government-sponsored agencies, they don't keep the loan on their balance sheet. They sell the loan to the agency, transferring the credit risk completely away.
So if that borrower defaults, Fannie Mae takes the loss, not Arbor.
Exactly. But Arbor retains the mortgage servicing rights.
Ah, okay.
They keep the right to process the monthly payments. And for doing that administrative work, they take a tiny sliver of the interest rate, maybe 40 or 50 basis points, before passing the rest of the money to the bondholders.
It sounds small.
It does. But when you are taking a sliver of $36.7 billion, it creates a massive annuity stream. Rain or shine, high rates or low rates, whether the bridge loan portfolio is burning down or not, Arbor is collecting $184 million a year in pure servicing fees.
So that's the cash buffer. That is what gives them the room to maneuver. And maneuver they did in a really massive way. The report outlines major capital stack acrobatics, where they generated roughly $500 million in additional liquidity.
Yeah, they were busy.
Let's dig into these specific moves because they are incredibly complex. First, they unwound something called CLO 17, which is a collateralized loan obligation redeeming $787 million in outstanding notes.
Right.
But if they are trying to conserve cash to survive a storm, why on earth would they spend nearly $800 million to pay off bondholders early?
Well, what's fascinating here is that unwinding a CLO is actually a defensive maneuver to regain control of their own destiny.
Oh, so?
A CLO is a securitization vehicle. Arbor bundles hundreds of their bridge loans together, puts them in a trust, and sells tranches of the cash flow to institutional investors. It's a great way to get cheap financing. But a CLO comes with a financial straitjacket.
Oh, the covenants.
Yes, the covenants. There are strict rules called over-collateralization tests.
Yeah.
If too many of the underlying loans in the CLO go into default, which, as we know, is happening, the CLO automatically traps the cash. It stops paying Arbor the excess interest and diverts all the money to protect the senior bondholders.
That makes sense.
Plus, if Arbor wants to help a struggling borrower by modifying the loan or extending the maturity date, they often can't because the CLO rules forbid it.
So by unwinding it and paying off the bondholders, they break the straitjacket.
Exactly. They unencumber those underlying loans. They bring them back onto their own pristine balance sheet.
So now they have total control.
Exactly. If a borrower needs a 6-month extension to finish a renovation, Arbor can just grant it rather than being forced to foreclose just because a CLO trustee demanded it.
Yeah.
It gives them the flexibility to work through the bad assets on their own timeline.
Okay, that makes sense for the CLO. But then there's the second major liquidity move.
Right.
They issued $375 million in new convertible notes, and they used those proceeds to redeem $270 million in older senior notes early. Why use convertible debt right now?
It's all about cash flow preservation. Regular corporate debt right now is incredibly expensive, maybe 9% or 10% interest for a company with Arbor's risk profile.
Ouch.
Right. But convertible debt allows the lender to convert the bonds into shares of Arbor stock if the stock price goes up in the future. Because the lender is getting that upside equity kicker, they're willing to accept a much lower interest rate today.
So Arbor is basically trading potential future dilution of their stock for lower monthly interest payments today.
Precisely. They replace expensive near-term debt with cheaper long-term debt, clearing their runway. They're essentially buying time for the commercial real estate market to recover.
But here's where it gets really interesting.
Yeah.
Of all these massive capital moves, the boldest one by far, the one that makes you do a double take when reading the 10Q, is what they did with their own stock.
It is wild.
I mean, if you're listening to this and wondering why a company facing a wave of foreclosures wouldn't just hoard every single penny of that newly raised cash, you aren't alone. It seems completely reckless.
It really does.
But they aggressively bought back their own shares. They spent $114.3 million to buy shares at an average price of $5.42. The report explicitly notes this represents just 49% of their book value.
Right.
And then they bought another $20.8 million worth at $5.85.
Well, if we connect this to the bigger picture, this is the most telling action in the entire earnings report. And it completely explains the psychology of the management team.
Oh, so?
Let's explain the mechanics of book value for a second. Book value is, very simply, what the company's assets are worth minus its liabilities. If Arbor liquidated tomorrow, paid off all its debts, and gave the remaining cash to shareholders, the accounting says each share should get roughly $11.
But the stock market was trading the shares at $5.42.
Exactly. Wall Street is looking at the non-performing loans, the foreclosures in Texas, the Fed funds rate, and they are pricing Arbor stock as if half of the company's net worth is simply gone.
Just vaporized by bad loans?
Vaporized. But management has an information advantage. They see every single loan file. By stepping in and buying their stock at half of book value, management is planting a massive flag.
Right.
They are saying the market is completely wrong about the severity of our losses.
It's the ultimate financial flex. They are telling Wall Street, if you are panic enough to sell us our own assets for 50 cents on the dollar, we will take that trade all day long.
It is a high-stakes bet on their own survival. And mathematically, it is incredibly powerful for the remaining shareholders.
Because it's accretive.
Yes. If the company is worth $11 a share in assets and they buy back millions of shares at $5, the book value of all the remaining shares instantly goes up. Plus, remember that 17-cent dividend we talked about.
Right, the one they are struggling to pay.
Every single share they buy back and retire is a share they no longer have to pay that dividend on. By spending $130 million to retire shares, they permanently reduce the cash drain of the dividend going forward.
Oh, wow. So it actually fixes the cash flow problem over the long run.
It does. But, and this is the massive caveat, it requires immense ironclad confidence in the true underlying value of the real estate collateral.
Yeah.
If management is wrong, and those loans in Texas are actually worth zero, they just wasted $130 million of precious survival capital.
That is quite the gamble. So what does this all mean? Bringing it all together, Arbor Realty Trust is essentially a case study in the extremes of commercial real estate finance right now.
It really is.
On one side, you have a highly stressed bridge loan portfolio that is undeniably dragging down GAAP earnings, generating mounting foreclosures, and skyrocketing credit loss provisions. It's ugly.
Very ugly.
But on the other side, you have this incredibly resilient agency servicing business acting like a toll booth, pumping out reliable cash, and you have a management team executing highly calculated, aggressive liquidity movers, unwinding CLOs to free up collateral, issuing convertible debt to lower interest costs, and buying back stock at deep, deep discounts.
It perfectly encapsulates the tension in the market right now. The pain is very real, the defaults are happening, but the sophisticated institutional players have deep toolboxes.
Right.
They have levers they can pull to navigate through the storm that smaller regional banks simply don't have.
It's a fascinating dynamic. You really can't just read the headline net loss and understand the company.
You really can't. And this raises an important question, something for you to really mull over as you digest these earnings.
Let's hear it.
We know commercial real estate is in trouble. But if a major, deeply connected insider player like Arbor, a company that sees the granular data on billions of dollars of apartment buildings, is willing to bet $130 million of their own cash to buy their stock at a 50% discount, while simultaneously doing the dirty work of foreclosing on bad loans, what does that signal about the true bottom of the market?
That's a great point.
Are we finally seeing the last painful flush before a real market recovery begins? Or is management catching a falling knife? And is this just the first domino in a much longer, more drawn-out crisis? Because Arbor is betting the house that the worst is already priced in.
That is the multi-million-dollar question. Will the toll booth generate enough cash to save the house flipping business? The tension between those mounting foreclosures and the aggressive stock buybacks is really the perfect summary of where the economy sits today. Make sure you follow the show for more daily earnings coverage and deep dives into the market's most fascinating financial reports. We will keep tracking this space because the plumbing of commercial real estate affects where everyone lives, works, and invests. Thanks for tuning into this deep dive, and we'll catch you on the next one.